Chair now recognizes himself for the purpose of an opening statement. First, I want to thank the witnesses for joining us. We'll go through the introductions in a moment, but I appreciate you taking the time to share your unique insights into the topic that we're examining this morning. And the topic, of course, is the regulatory burdens on rural banks. And these burdens are not a new matter, but the fact is our rural banks and financial institutions are among the smallest financial institutions in the country, and they are struggling in the current regulatory environment. I helped to start a small bank in the Lehigh Valley of Pennsylvania and the western part of New Jersey with the goal of lending to small businesses and local residents, and that was back in 2005. So I have some firsthand personal experience with the regulatory environment as it existed then. It has clearly gotten much worse in the meantime. What I think sometimes folks from urban and suburban areas may not appreciate is the extent to which in rural areas a town's local bank is often a citizen's first, sometimes only, exposure to the financial system. And these banks survive by offering exceptional service to these customers, personalized products, and fostering an ongoing long-term relationship. The fact is, in small towns across Pennsylvania and the United States, George at Bailey Building and Loan on Main Street still exists. Unfortunately, new regulations are straining the business of continuing to bank rural customers. Congress and the President attempted to deal with threats to our financial system that were threats that were posed by a handful of the largest institutions in the world in 2010 through Dodd-Frank. But unfortunately, even the smallest institutions have been caught up in regulation that has resulted in more red tape. In fact, in some ways, this burden has been disproportionately felt by banks that are small and rural, even though some of them have some of the healthiest balance sheets, business models, and relationships in the entire financial sector. The fact is, compliance costs are, at least a portion of them, are often fixed costs, and small institutions have a smaller revenue source with which to absorb those costs. There's a striking example of the harm that has been happening in the very small bank and the new bank sector, and that is the absence of new bank charters that have been issued recently. We have a chart here that depicts what has been happening across America. Between 2000 and 2009, the vertical gray bars on the graph reflect the new bank charters each year. And what you can see is that that number completely collapses and goes to zero after Dodd-Frank is passed. In fact, since 2010, only 2 de novo banks have been formed. The red line is a measure of the amount of new regulations that have been imposed on financial institutions. And you can see the dramatic upward spike corresponds roughly, but pretty well, with the complete collapse of the formation of new banks. This, I think, is devastating. The fact that America no longer launches new community banks is devastating for Americans across the country. But I understand why it's happening. I mean, it's hard for me to imagine taking the risk of starting a new bank today, having had that experience in the past, given the combination of this avalanche of new regulations that one faces and the artificial interest rate environment where interest rates are basically at zero and margins are so compressed. Well, apparently, I'm not the only one that can't imagine starting a new bank. Nobody is doing it anywhere in America. So we've destroyed de novo bank formations. That no longer happens in America. And we're forcing a stunning wave of consolidation among small banks. It started a long time ago, but it's been accelerating recently. And as we have this consolidation, we're not replacing these institutions with new startups. A Harvard Kennedy School paper in 2015 said, and I quote, "Community banks' vitality has been challenged more in the years after Dodd-Frank than in the years during the crisis." And again, I quote, "The rapid pace of consolidation away from community banks that has occurred since Dodd-Frank's passage is striking, given that this regulatory overhaul was billed as an effort to end too big to fail." The fact is, in the absence of new community banks and the absence of a thriving small bank sector, we have less competition, less dynamism, and fewer financial services for for men and women and small businesses who need these services. So this committee, we've been working for some time now to try to provide some regulatory relief for the smallest financial institutions. We've had 5 hearings focused on community banks and credit unions, 2 others on credit access for small businesses. We had the Financial Regulatory Improvement Act of 2015 with dozens of measures designed to provide relief. I'm proud to have authored several of these provisions in separate bills that got rolled into one, and I'm very disappointed that we have not been able to get bipartisan support so that we can move this on the Senate floor. I do want to also point out one particular industry that depends so much on the smallest of banks, and that's agriculture. It is very often the case in rural agricultural areas that there's only one financial institution, and it's often a very small community bank or credit union that provides credit to the ag community in that market. But these small institutions in the aggregate provide a huge percentage of all agricultural lending. This chart depicts that. The light green area on the top represents the percentage of all loans that are made, agricultural loans, that are made by banks that are less than $1 billion in total assets. And you can see that's about half of all the loans. The dark green area are loans that are made by banks of $1 to $10 billion, still quite small. Combined, you can see this is over 70% of all the loans that are made to agricultural America are made by small and very small banks. This is an absolutely essential part of the financial services industry for rural and agricultural America. So the fact is, while we've been unable to provide this regulatory relief, in my view, the burden is carried not just by financial institutions, but folks on Main Street and folks in the rural communities who would otherwise be served by a more robust small banking market. Our witnesses today represent institutions that have been unduly burdened by Dodd-Frank and other regulatory creep. I hope their views and suggestions will be taken into account as we continue to pursue ways in which we can relieve that burden. And with that, I will recognize the ranking member, Senator Merkley, for his opening statement.